The global financial landscape has shifted dramatically, and the undisputed heavyweight champion of the last decade is suddenly looking bruised and battered on the ropes. Bitcoin, which not too long ago was heralded as the unstoppable future of decentralized wealth, has watched more than half of its value evaporate from its all-time high. The financial elite are wasting no time dancing on its grave, with some of the world's most revered traditional investors flatly declaring the asset completely worthless. To make matters worse, the corporate poster child for crypto accumulation, MicroStrategy, has shown structural cracks that have people panicking about whether the entire system is fundamentally broken or if we are standing on the precipice of a rare, wealth-generating fire sale. To truly decode what is happening, we have to look past the surface-level chaos of the cryptocurrency market and dissect the structural mechanics driving this collapse, from institutional unwindings to the shifting psychological patterns of global liquidity. At the core of this recent price collapse are a few blunt macroeconomic realities, starting with a massive, systemic migration away from risk. When inflation persists and geopolitical tensions simmer, investors stop chasing speculative moonshots and retreat to the safety of cold hard cash, short-term bonds, and government treasuries. Compounding this problem is the fact that the speculative capital that used to flood into crypto has found a new, shiny home in the artificial intelligence boom, leaving the crypto ecosystem severely starved for fresh liquidity. This liquidity drain is being amplified by the very financial vehicles that were supposed to institutionalize Bitcoin, the spot ETFs. When these funds were launching, they acted as a massive upward engine, forced to buy physical Bitcoin to back every share retail investors gobbled up. Now that exact machinery is running in reverse. As panicking investors dump their ETF shares, fund managers are legally obligated to liquidate their underlying Bitcoin reserves, creating a brutal, automated selling pressure that hammers the price down day after day. This institutional bleeding is happening at the exact same time the market's biggest players, the whales, are actively heading for the emergency exits. When entities holding tens of thousands of coins dump massive blocks of supply in a single week, it sends a shockwave of panic through retail investors who assume the smart money knows something they do not. This panic is find a fertile ground because the market has completely run out of intoxicating new narratives to keep the hype alive. A year ago, the space was buzzing with talk of sovereign strategic reserves, a flood of corporate adoption, and wild price predictions stretching toward $1 million. Today, those legislative dreams are stuck in bureaucratic gridlock, institutional demand has cooled, and the broader public attention has shifted back to old-school safe havens like gold and silver. This lack of fresh capital means there is no one left to buy the top, exposing a profound loss of conviction among everyday holders. For years, the core thesis was that Bitcoin would act as digital gold, a bulletproof hedge against inflation, money printing, and global chaos. Yet, when real global instability arrived, traditional gold smashed records, stocks rallied, and Bitcoin sank like a stone, shattering the narrative and forcing a mass exodus of disillusioned believers. To understand how deep this rabbit hole goes, you have to look at Michael Saylor and his company MicroStrategy, which has essentially tied its corporate destiny to the fate of the blockchain. Back in 2020, the firm pivoted from a standard software business into a massive, leveraged Bitcoin treasury, aggressively using its balance sheet, issuing corporate debt, and selling stock to accumulate roughly 4% of the entire global supply. The staggering reality of this strategy is that with prices depressed, MicroStrategy is sitting on a multi-billion-dollar paper loss. While the internet loves a good doomsday narrative about a catastrophic margin call forcing the company to liquidate its hoard and crash the market to zero, the structural reality is far more nuanced. They did not buy their coins on a simple margin account. They raised capital through convertible debt and preferred stock, meaning the immediate pain is felt by the shareholders rather than a forced liquidation engine. However, the real danger lies in their newly created dividend funds, designed to raise capital assuming a high stock price. With their main stock cratering, the market is betting they will not be able to fulfill their promised dividends, forcing the company to alter its framework, expand its reserves, and quietly authorize the sale of Bitcoin if things get desperate. A sudden pivot that has already invited fierce regulatory scrutiny and class action lawsuits from disgruntled investors. While this corporate drama feels entirely unprecedented, taking a step back and looking at the broader historical cycles reveals that this agonizing volatility is actually completely on script. Over its history, Bitcoin has routinely endured stomach-churning drawdowns of 50, 70, and even 90%, only to rebuild and scale new heights. The asset operates on a remarkably consistent, almost mechanical 4-year cycle tied to its underlying code, moving predictably from quiet accumulation to a manic, FOMO-driven parabolic spike, followed by a devastating, capitulatory crash that leaves the casual observer assuming the asset is dead. The trick to surviving this ecosystem is recognizing that the absolute best time to buy is usually when public interest is at its absolute nadir and the consensus is that the experiment has failed. Historically, the most reliable metric for finding the true cyclical bottom has been the realized price, which measures the average price at which every Bitcoin in existence was last moved, essentially acting as the collective break-even point for the entire network. Every single major bear market bottom has been defined by the market price briefly dipping below this realized price line, triggering a final, agonizing wave of investor capitulation before a true, long-term reversal begins. Naturally, the financial world remains deeply and fundamentally divided on whether this cycle will repeat or if the asset is finally heading toward its intrinsic value of zero. On the ultra-bearish side of the aisle, legendary value investors and macroeconomic analysts view the entire space as a useless, speculative mirage that produces no cash flow and will eventually collapse under its own weight. While technical research firms warn that current demand is incredibly weak, pointing to charts that suggest a much deeper drop is required to shake out the remaining weak hands. Conversely, major institutional asset managers and banking firms are still quietly publishing incredibly bullish long-term forecasts, arguing that the asset's survival through systemic liquidations, international bans, aggressive regulatory crackdowns, and macroeconomic tightening proves its ultimate resilience. Navigating this chaotic environment requires keeping emotions completely detached from the daily price tickers, understanding that greed leads to buying the absolute top and terror forces selling the absolute bottom. The ultimate strategy for dealing with an asset this volatile is a cold, calculated approach. Maintaining strict position sizes where a massive drop will not impact your daily survival, employing pragmatic moves like tax loss harvesting to offset capital gains during downturns, and consistently doing the exact opposite of what your panic gut tells you to do when the headlines look the darkest.